Hello, hello. Welcome to another episode of Financial Tides. I'm your host today, Taylor Perillo, certified financial planner, and we are going to be discussing whether or not to convert to a Roth IRA or not. So, I know you've heard this debate before, if you've heard anything financial, or maybe it's your first time coming into this debate. But there's two different types of IRAs out there. There's the Roth IRA, which is a tax-free, you pay the taxes on the front end and it's tax free on the growth. And then you have the traditional IRA, which is the one that is tax deferred. You get a tax write off on the way in, or you put money in via 401k and eventually roll it over into an IRA. And then you pay the taxes when you take out the funds, including on any growth that you have. Why are we talking about this topic now? Why is it relevant again? Why is it such a big topic? And it's because of the One Big Beautiful Bill Act. So if you haven't seen our episode on the One Big Beautiful Bill, I highly recommend doing that. It has shifted the tax landscape in a couple different ways, and it's making this Roth discussion more relevant than ever before. So I think kind of high level about that without going into the whole One Big Beautiful Bill. The reason the conversation is more relevant again is there's lower tax brackets for a long period of time. It's not sunsetting at the end of this year like it was previously. There's higher standard deductions, and there's a set of rules that seem to design flexibility and give greater consideration to Roth conversions. We're going to talk about it, but like every financial planning, the answer isn't the same for everyone. It's not black and white. So we're going to kind of break down some of the details of what goes into that conversation, and then some of the situations where a Roth conversion is really a slam dunk for that kind of category of people. We'll walk through those benefits, the new opportunities, and kind of the things to watch out for. So, to start, what is a Roth conversion? A Roth conversion is when you have your money in a traditional IRA and you want to pay the taxes on it now and change it over to a Roth IRA. So you're converting it from one type of IRA to the other. A couple key factors when doing this is if you're under 59 and a half, you 100% of the time do not want to withhold taxes. Anything you withhold would be subject to that 10% penalty. And almost 100% of the time, and every time pretty much we recommend it, you don't want to withhold any taxes anyway, because if you're converting it, you want to have the maximum amount that you're converting go into the Roth growing tax free, because there is a limit. So the normal limit for funding a Roth is you can add $7,000, $8,000 if you're over 50 a year. If you could only add that much, but you can convert as much as you would like, we want to convert as much and keep as much going into the Roth as possible. So you have the maximum amount of dollars growing tax free. So that's kind of just high level what a conversion is some of the basics of how you want to accomplish a Roth conversion. So why do a Roth conversion? What are some of the appeals of doing it? Well, I already hit on one. It grows completely tax free. So if you do the basic rules, which is 5 year holding period after you convert it, your withdrawals are completely tax free, meaning that if you put in $10,000 to make the math simple, it doubles to $20,000. That extra $10,000 that you gain, you don't pay any taxes on it when you take out. That's simple. When you magnify that on a larger scale, where you're converting $25,000 a year over a 10, 20-year period, it can be a pretty big difference. And then the other appeal is just income flexibility. So with traditional IRA, you have what's called a required minimum distribution. If you're not age 70 and a half, 72, 73, they've changed the age a couple times. It's going to be 75 for a lot of the younger listeners out there. But at that age, you're required to take a certain percentage each year from your traditional IRA account. So if you have a very, very large traditional IRA account, it could force you to take income that you're not even spending, and it could cause you to be in a different tax bracket. So it's a huge planning advantage to have control over the income, being there is no required minimum distributions for Roths. And even if there was, anything you take out would have no implications on your tax situation. And then Roth is one of the best, and I can't reiterate this enough, ways for legacy planning. So many times, almost 100% of the time now, your heirs are going to be in a tax bracket that is different than yours. It's very rare that we see the heirs in the same tax bracket as their parents, and almost 100% of the time now, at least with our clients that we're seeing that we're working with both generation, the children are in a higher tax bracket than their parents. We know tax brackets are at an all-time low, or historical low. I wouldn't say all-time low, but historical low for recent years. So makes a ton of sense if you're in a lower tax bracket than them, and they might be in an even higher tax bracket down the road if tax brackets were to ever go back up. Um, it makes a ton of sense to pay taxes now while you're in a lower bracket and the brackets as a whole are lower, so you can give them a tax-free distribution once they actually inherit those funds. So I think it's just one of the many ways that it shines through, and I think that it's a gift both to yourself because you're leaving the government out of inheriting a big portion of your funds, especially with Secure Act 2.0, which basically forces all retirement accounts to be distributed within 10 years of inheriting them. So if your child already making, say, $300,000 a year, they're in a 32%, 24, 32% tax bracket. If they have to inherit a large IRA account and distribute that within 10 years, they're going to be forced to take a lot of income and pay a lot of extra taxes on that. Where if it's in a Roth account and they distribute it within 10 years, they have zero tax implications to distributing that. The only reason it has to be out within 10 years is the growth. They don't want it to keep growing tax free beyond those 10 years. So I think, again, legacy planning, huge, huge opportunity for people, giving a gift to your heirs in the form of having one less tax burden to worry about, even though it's on an asset that you're leaving them. So, what's changed now with one big beautiful bill, and why is it making it an even better time to do Roth conversions? Well, we hit on the fact that the lower tax brackets under the 2017 Tax Cuts Job Act are still here. They're here to stay. They're not sunsetting, so it's going to cost less than it would have been prior to 2017 to do these conversions. And if it goes up in the future, which at some point we think it would be likely that it would go back up in the future, we don't really see it getting any lower. So now is the most opportune time to start doing conversions and keep doing conversions um, within your tax brackets. So the biggest thing, though, that's making it more relevant is the higher standard deductions and the seniors 65 and older under a certain income threshold getting an additional $6,000 per filer, which equates to $12,000 per couple. So that's an extra $12,000 per couple or $6,000 for a single filer that you were not getting on last tax year's return. You don't have anything that you have to do to qualify for this except to be under a certain income threshold. And that just basically gives you $12,000 of income that you can convert, or 6,000 if you're single, without having any different tax situation from the year before. So I reiterate, there's income thresholds. It starts phasing out at $75,000 for single filers and $150,000 for couples. And I think the top end of that is 150 and 250 respectively for single and for couples, of where you'll be completely phased out of that and not get any of that benefit. But large conversions, we don't want to use those and have it push you over those limits and lose your senior deduction. So we'll keep those in mind when we're doing the conversions. We don't want to push and lose deduction just for the sake of it. And then I think that as a whole, we really want to make sure that we are taking advantage of these extra dollars that you have, because this $6,000 and 12,000 bonus deduction for seniors is only until 2028. So that's the important part. So why are we talking about this now? You have 4 years to do this: 2025, 2026, 2027, and 2028. You will lose out on that $12,000 or $6,000, whichever category you fall into, once that 2028 comes around, unless they put something in and extend it. So we want to make sure we're at least taking advantage of those 4 years while they're here. On to the other ancillary items that kind of are considerations when you're doing a Roth conversion as well. There's the Medicare impacts on this. So again, your modified adjusted gross income is what triggers what's called IRMA, income related Medicare adjustment surcharges. So that's a higher premium you would pay for your Part B and Part D of Medicare. We want to take that into account as well. We don't want to convert too much and push you into having to pay higher premiums, unless it makes a ton of sense to. It's not often that we see situations where it makes sense to push you into paying more, but it is something to consider. But for the most part, we're taking those into account when we're doing conversions. The other is net investment income tax, which is 3.8%. If your modified adjusted gross crosses a certain threshold. So that's just an additional tax. They sometimes nickname this the Obamacare surcharge. It's the piece of the tax bill that is paying for some of the Obamacare when they came in together. So it's just an additional tax that you would have to pay on your net investment income once you're over a certain threshold. So we want to take that into account as well. Next is state taxes. So not all the states are Roth friendly. High tax states such as California, a Roth conversion could push your effective tax rate if you combine everything together to 45 or 50% if you don't do it right. And with SALT deductions, you're capped out, so you don't get much of a relief in a state like California. States like Florida with no income tax, there's almost no reason not to be converting on the state level. You have to do them both together. You can't do them individually, but the state is very friendly in a state like Florida with no income tax. I touched on the 5 year rule earlier. I think it's just important to reiterate this as well. Roth IRAs don't have just one, but they have multiple 5 year rules. So each time you convert, it starts a new 5 year clock for when you can withdraw those assets penalty free. So it's important that if you're going to spend the funds in the next 5 years, you're not going to be trying to convert right leading up to that. So the good news is if you're converting for many, many years, the 5 year clock is starting each time. You can start using those funds from the earliest conversions first and do the funds from the last 5 year conversion later down the road when that 5 year clock has passed. And you'll have plenty of funds, hopefully, in both, but we'll make sure of that before. Earnings require both the 5 year clock and age 59 and a half. So again, if you're going to convert funds, we want to make sure you're not trying to access those, at least the earnings portion of those prior to age 59 and a half. Otherwise, there will be a penalty. So again, it's something we'll account for in planning, but that's no different than the traditional IRA. There would be a penalty whether it's in Roth or traditional IRA prior to that 59 and a half. So basically, anytime you need flexibility, a conversion could cause some headaches. So we'll definitely want to talk about the need for liquidity and need for funds prior to converting. And then some of the strategic scenarios and kind of how they come into play. So one of the situations that you could really take advantage of a strategic conversion is an early retiree in a low income window. So say you retire at age 60 and you're not starting your Social Security till 67. You have a big chunk of after tax money that maybe came from property sale or something. So you're not using your IRAs as much, or you're not using some of the other funds that you have that would create taxable income in those early years. It's a prime window for conversion. So converting while you're in that low income window until Social Security starts, until your after tax money runs out, and then you'll have a tax-free bucket for life. So that's one example. There's the market downturn conversion. So if the market falls, your traditional IRA account balance would typically drop. This is a good time because you can convert more shares And then when it rebounds, the growth will be happening inside the Roth account, not inside the traditional IRA account where you'll have to pay tax on the growth when it comes out. So that's another good, if you see the market crash, great time to say, hey, let's do extra Roth conversions or let's do the Roth conversion now. And then I think the last one is just back to the whole heirs thing. If you have heirs that are in tax brackets that are much higher than yours and much higher earners, and it's likely that you may not be around while they're still working, it makes almost 100% sense to convert even beyond your current tax bracket just because you're going to leave them assets that are way more tax efficient for them. And if you're leaving them assets anyway, you don't want any of it going into Washington and your state capital's pockets when it could go into your heirs' pockets instead. So better to pay the tax now and grow an asset tax free for them. So, the final takeaway really today is the one big beautiful bill didn't rewrite the Roth rules. It didn't change the playing field, but it did kind of give us more opportunities with the lower brackets extended. We can do Roth conversions cheaper for a longer period of time, higher deductions, and a bunch of market volatility that's kind of happening is giving us kind of unique entry points to do Roth conversions. So, if you haven't considered Roth conversions, it's not one size fits all, but it's something that we're having a conversation with a lot more now that one big beautiful bill has passed. And I think it's an opportunity to kind of enhance your financial situation of both you and your heirs. So if you're considering doing a conversion, let's have a conversation. Don't hesitate to reach out, call, schedule a meeting. I think if we do these strategically, Roth conversions in the right scenario can be one of the most powerful moves in your financial plan. So I would say give us a call. We're happy to help. And thank you for watching Financial Tides. We'll see you next time.
John Perillo and Taylor Perillo are financial advisors offering securities through Cetera Advisors LLC, a registered broker-dealer, doing insurance business in California as CFGA Insurance Agency LLC, member FINRA/SIPC. Advisory services offered through Cetera Investment Advisors LLC, a registered investment advisor. Cetera firms are under separate ownerships from any other named entity. California insurance licenses number 0F60123 and 0M90666, 6265 Greenwich Drive, Suite 251, San Diego, California 92122. The views depicted in this material are for information purposes only and are not necessarily those of Cetera Advisors LLC. They should not be considered specific advice or recommendations for any individual. Neither Cetera Advisors LLC nor any of its representatives may give legal or tax advice.